Welcome back. Futures indicating a higher opening this morning. Take a look. Dow Industrials right now up 15. The Nasdaq up strongly, up 67 right now, 0.5%. S&P 500 higher by 8.25. Interest rates are pulling back as stocks move higher. Take a look at the yield on the 10-year Treasury right now, way below the 4% number at 3.98%. That is down 4.5 basis points right now. All of this 5 minutes away from the December Consumer Price Index out in 5 minutes' time. The expectations are these: up 0.2% month over month, up 3.2% year over year on the CPI. Joining me right now is Macro Mavens President Stephanie Pomboy. Stephanie, great to see you. Welcome back and Happy New Year.
Happy New Year to you, Maria. Thanks for having me.
Is it going to be a happy year for the economy and what we're looking at in terms of these markets? What are your expectations for inflation and the Fed this year?
Well, I think the inflation story is going to be a really interesting one that may play out a little differently than the markets or the Fed perceives, and that is, I think the trip from 9% to 3% was pretty smooth and rapid. Getting from 3 to 2, however, I think is going to prove far more challenging, and there are a variety of reasons why that is likely to be the case. First, starting with the obvious, the math, year-on-year comparisons played a huge role in making it easier for us to get to 9 to 3. And the math gets a lot more challenging once you get into March and thereafter. The second thing, and perhaps more importantly, is we've had a huge inventory liquidation cycle that really, I think, was the primary driver of the move from 9 to 3. That inventory liquidation cycle is largely complete now. You know, remember, after the pandemic and the supply chain disruptions, companies double and tripled ordered and ended up being, having this massive overhang. They've now substantially unwound that. So the question is, do they start to rebuild that? Or just kind of hold inventories where they are. Either way, the disinflationary impact from inventories is over, and I think the odds are that they actually start to be more of an inflationary force as people look to rebuild inventories, and that's in part because of now the renewed supply chain dysfunction that we're seeing as a result of the war in the Middle East, atop of the continued issues around getting things out in and out of Eastern Europe with the war on the Ukraine. So there are a variety of reasons to expect getting from 3 to 2 might prove more challenging, and this expectation that the Fed's going to have lots of runway to cut rates will begin to be questioned, and that's probably going to be a negative for the markets, but only time will tell.
Well, Fitch credit rating is no longer forecasting a recession this year due to several signs of the strength of the economy, it says. It's also predicting the Federal Reserve will cut interest rates 3 times in 2024, which, of course, is where the market is, or the Fed has said that already. I want to get your take on earnings as well. That's the fundamental story. J.P. Morgan will kick off the earnings season tomorrow morning, but I spoke with the CEO before that, and I asked him to give us a sense of his expectations for 2024. Here's what Jamie Dimon told me this week. So what about the future, Jamie? What kind of a 24 are you expecting?
Yeah. So, I look at when you say we had a strong year, we acknowledge we're over-earning on NII and credit and stuff like that. And, of course, I'm much less worried about the economy and the strong year and what's going to happen next year than the geopolitical stuff.
The geopolitical stuff is modeling in some upset for Jamie Dimon. Stephanie, I want to get your take on this because when I spoke with him about the broader economy, he says he's not buying it, this, soft landing scenario. Here he is on that. Watch.
The good news is the consumer has jobs, wages are going up finally more at the lower end, home prices are up, which is good for their balance sheet. But I'm a little skeptical in this kind of Goldilocks kind of scenario. I still think the chance of it not being a soft landing are higher than other people. That's not terrible. It might be a mild recession or heavy recession.
What do you think, Stephanie? Do you agree that we'll see a recession this year?
Well, I think obviously there are a ton of economic indicators that have long since signaled that we were going into recession. And I think if you ask the average guy on Main Street whether or not we were headed into recession, they would say, hey, we're in recession already. So it's a perception between Wall Street and Main Street. But as relates to what he's saying, I think one of the real issues or the big question in my mind is, does the Fed actually cut in advance of a decline in the stock market or a crack in the economy. Because right now, that's what they signaled at that last meeting. I mean, as you and I have talked about throughout the entire year last year, I expected that the Fed was going to stay higher for longer, and that ensured that we would have a dramatic issue either in the economy or the financial markets.
Let me interrupt, Stephanie. Markets just turned negative. CPI is out.